A very good afternoon, friends. It gives me immense pleasure to welcome you all to today's webinar on business valuation in a startup era. This is our 90th webinar and our journey of knowledge sharing will continue. Thank you all for joining in our journey and encouraging and motivating us in our knowledge sharing endeavor. In the word of Hon'ble Prime Minister, startups are the engines of exponential growth. Manifesting the power of innovation, several big companies today are a startup of yesterday. To harness the enormous potential in startup towards building self-reliant India, Government of India took the flagship initiative to provide continuous support and handholding to startup. The objective of the webinar is to analyze and deliberate the business valuation of startup. The discussion will be on current and future trend, challenges faced in business valuation along with the effect on various industries. Over here, we discuss issues pertaining to ways of valuing the company, ways to negotiate valuing with investor, taxation and other various things which are around the valuation. Key area for discussion will be today, startup ecosystem and its trend in India, requirement of business valuation for startup, regulatory and transaction valuation because both are different, importance of financial modeling in preparing business valuation, understanding valuation from the investor perspective, and the ways to negotiate valuation with investor, methodology and challenges faced for the business valuation of the startup at various life cycle of startup, valuation of loss-making companies with specific valuation of parameters based on new age industries such as artificial intelligence, virtual reality, e-commerce, process of fundraising and impact of valuation across the timeline of the same. We have galaxy of experts. Before I invite them to make their presentation, let me perform the pleasant duty of introducing them. First, Mr. R.N. Malu is a rank holder chartered accountant having 35 years of experience in field of finance, accounts, taxation, audit, investor relation, corporate affairs. He started his career as a partner at Kalani and Company and reputed firm of chartered accountant. After 10 years of praiseworthy, after the 10 years of practice, he moved to the industry. He worked as a CFO in textile, steel, real estate, and FMG company like Bhaskar and Surya Roshni Limited. I welcome Maluji for the program on the valuation in the startup era. And we will definitely get benefit of your experience and your interaction with multiple people in this area. Then we have Manoj Kumar. He is partner and head M&A Insolvency and Transaction Advisory of Corporate Profession. He is a member of National M&A Council of Association, Insolvency Committee and CCI and Company Law and Corporate Governance Committee of PSD. He has addressed numerous professional development programs organized by forums such as SOCM, CS, CA, IICA, Nalsar Law University. He is also a prolific writer and has co-authored books in Companies Act, Insolvency and Business Valuation. His research orientation is evident from several articles written by him on topics related to merger, demerger, takeovers, and insolvency resolution. His quotes and comments are regularly carried in all major dailies, financial dailies, e-paper, and business magazine. I welcome Manoj for this program because when you do transaction, the first thing struck that is the valuation, and understanding the valuation from the person who is doing transaction is important and very valuable input for all the people. Thank you, Manoj, for joining. Then we have Mr. Sanchit Vijay. Sanchit is a chartered accountant and professor, possessed diploma in strategic management from LS London School of Economics and Political Science. He has also been attended certification in mutual fund and equity derivatives from NSC Academy. Besides, he is an IBBI registered valuer for securities and financial assets. He is presently partner and head deals and valuation corporate profession. Earlier, he served as the associate consultant, data and analytics of Infosys Limited and equity research analyst at CapGrow Capital Advisor LLP is a PMS fund. He has co-authored some of the CP research publication and written article which has been published in professional journal, online portal and business magazine. He has planned, addressed and attended several webinars during the ongoing COVID-19 pandemic. He is an out-of-box thinker and known for giving innovative ideas and insight for the growth of business. His approach, and as a new generation professional, he understands very well about the startup mindset and their need. I welcome you, Sanchit, for this program. Friends, what we will do, the program we are dividing into such manner that first, Manoj will discuss about the startup ecosystem, financial model, and investor perspective. Then Sanchit will give a presentation of valuation methodology, parameters, process, and impact of the valuation. Then Mr. Malu will discuss about the industry perspective. Then we will take a question answer. If you have, I have received some questions. Before starting this session, friends, as you are aware that India is becoming the world fastest growing startup ecosystem with 102 unicorn startup as of 2022. The unicorn mean that somebody who has touched the $1 billion funding and the valuation. Recently, two startups, yesterday, have joined the League of Unicorns, namely Physics Wala, that is EdTech startup, and Purple, beauty and personal care retailer. These are the two startups, those who have joined and making the tally of 102. India has the third largest startup ecosystem in the world after US and China, expected to witness year-on-year growth on the consistent annual growth of 12 to 15%. And that is very, very impressive and very high. India has about 50,000 startups in India in 2018. Around 8,900 to 9,300 of these are technology-led startups. 1,300 new tech startups was born in 2019. Along it implies that there are 2-3 tech startups born every day. And that is very, very phenomenal. And that is giving a new dimension. The Indian startups have reportedly raised around 42 billion in funding across 1,548 deals in 2021. That is also a huge number. So far, fair practice and valuation of startup become very crucial in the race of becoming unicorn. Now these startups are going on public also, and we have seen the various startup Car Trade, Freshworks, Nykaa, Policy Bazaar, Paytm, MapMy, India, Zomato, Deliver, and Nazara Technology. These are the listed Indian startups. And friends, the most important thing which we have to understand, the ecosystem which is developing in India and the spiral growth which will take place. What is happening? The most important phenomena which is happening, that these are the 50,000 startups, they are getting funding. I have just told you that $42 billion has come in 1,584 deals. And majority of these companies, they have given ESOP to their employees, their people, their top management. Now, the point is the value of the ESOP is becoming in crores, 1,500, 200, 300 crore. And I will tell you, the mindset of these people, those who are in startup, that is totally different. And Mr. Malu will agree with me that we all are of a old age system. And these people are new age thinker. They provide new dimension to any problem. They think this is the problem, this is the solution. We have lived in the problem and we have thought this, कि ये तो हमारे भाग में ऐसा ही है. But these people, those who are changing the landscape of the ecosystem of the startup, that is very, very important. And what I'm seeing, the future. Now, all these startups which are there, say, just take example, these 1,500 startup got 42 billion. And there is a possibility out of this 40 billion, 10 or 12 billion has gone to the employees quota in the ESOP and other thing. Now, these people, when they are working in the company, so I have seen that so many people have given funding to the startup, 5 crore, 10 crore, 2 crore, 1 crore, and a small. So the huge number of people are coming into this. New things, new development, new ideas, which you have never thought and which is very, very simple. You are not thinking like, just I was thinking this physics wala. The physics wala is teaching only physics. Other Beju, another thing, they are teaching all the subject. So you can understand that physics wala has become the unicorn. Then you can understand the market size, the people, the things which is taking place. And I'm expecting this ecosystem will grow, and shortly we will be on the top shortly, the way things are moving. So today, friends, with this hope that India will do something, India will blast in this area. That is not that is not just I'm just saying for the saying. And I'm expecting that next year when we'll meet sometime, I will come out with the same data and I'll talk to you that how much we have progressed. Friends, the valuation is, there are multiple types of valuation when we have heard. We say book value method, we say discounted cash flow, we can net asset value. These are the 3, 4, 5 word which is popular. But when we talk about the startup valuation, that we have to understand one very important thing, that in the startup, they have an idea, they have a future growth, they have done something. So some of them have idea, some of them have done something, but the actual potential has not reached. So the valuation is tough and valuation is different. So I was just thinking that book value we have seen, discounted cash flow we have seen, but the startup valuation, the comparable transaction method, that is a startup valuation. The scorecard valuation method is also there. Cost to duplicate approach is also there. Risk factor summation method is there. And then Burkas method, that is a venture capital Dave Burkas, who has came out with the pre-revenue method, and he has given a new concept. So the method is in his name. So these are some different types of valuation method for startup. So today we will discuss all these issues, all these points. So first I will request Manoj to tell us the ecosystem, tell us the larger picture, and then Sanchit will take up the valuation part. Over to you, Manoj.
Good afternoon, sir. Good afternoon, everyone. So as sir has already said, and that India's startup ecosystem is flourishing. We all know it is a buzzword. Everyone is talking about startups. And why not? It has become world's third largest
Manoj, your voice is, can you speak a little louder?
Yeah, okay. So startup is a buzzword right now, and every second youngsters are aspiring to become an entrepreneur, because there are many icons like maybe Vijay Shekhar or Ritesh Agarwal, who has created a huge size of a startup and successfully delivered to these days. So sir has already told you that there are India has got 102 unicorns by now. So every unicorn has got a lot of money from investors from across the world. So this shows that the confidence in the Indian startup ecosystem, and because of this. There are many regions. One of the we will discuss all those regions which led to this growth of the startup ecosystem in India and faster growth, and what are the methods, what are the aspects based on which valuations are carried in case of startups. So our discussion will be basically we will discuss about the Indian ecosystem with respect to startups, the major growth drivers in India, trends which are happening, and then fundraising and valuation aspects in case of startups, requirement of fundraising, valuation if we are going for startups, regulatory aspects, and transaction valuation. And then Sanchit will discuss the approaches of valuation which may be applied in case of startups, because the startups are very unique. They have sometimes very nascent business, but they have very good idea. So how to value the idea, those are the critical aspects we will discuss during this discussion. So what are the startups? Basically, there is no specific definition to startup. Startups are generally early stage companies which have newly formed in a business model or a company. They are basically full of risk. They have no means of fund, but the idea is very good. There is expandability. They have option to disrupt the market or replace certain things which are traditionally going on but has a lot of hindrances. So those are the critical aspects. Based on that an entrepreneur decides that this is the area where we should enter into. So over a period, many kind of startups have grown. Maybe e-commerce related startups we have seen: Amazon, Flipkart, Snapdeals, etc. Some have failed, some are now growing. Then this e-commerce became quick delivery systems also. So those type of thing, those kind of startups have also came. Then direct to customer consumer startups are there. EduTech has become very important sector, like which is leading in India through Byju's, right? So Byju is one of the largest valued company in India, startup company in India. Then there are many SaaS companies which are providing various kind of technology related solutions. Then new technology like machine learning, IoT, AI, all those areas are very much promising area where many of the startups are coming. Then uh, online gaming systems are coming. Then cryptocurrencies and this kind of startups are also coming. So this journey in India, startup journey, started in 2001. I think the first unicorn startup was recognized in 2001 when Byju got the funding, and from there was a very slow growth till 2016. 2016 there were around 600 startups, recognized startups in India, but after that this growth was tremendous, and now it has around 70,000 startups in 2022. So this, and as sir has rightly said, there is a year-on-year growth of around 16% in India. We can see the funding also in the startups by this chart. In 2014, total fund raised was around 5.84 billion dollar in India, which has now grown to in 2021 it has become 42 billion dollar. So this is a huge jump. Similarly, the number of started from 17 to 2022, we see around 70,000 startups have come. And as we see, we have very fast surpassed the number of startups, unicorns in United States and France and Germany, and now become the third largest startup ecosystem in India. We have 102 unicorns. Each unicorn means having more than $1 billion valuation. So the valuation of overall startups is also very huge in India now. Then, so what are the policies and what are the reasons why Indian startup is growing so fast? One of the biggest reason is the government policy. The government has created many of the policies which are supporting the growth of startups. They have liberalized policies with respect to foreign exchange. Then they have given obviously promoted the investment by all kind of investors, venture capital funds, private equity funds, hedge funds, and also technology companies like Facebook, Google, and Microsoft. They are creating new startups. They are creating ecosystems around the new technologies. Then overall, in last 5 years, there has been a huge internet penetration in India. Even tier 3 cities, even rural areas, there is internet connectivity, which has created very good ecosystem for growth of e-commerce, e-commerce startups and other edutech startups. Then there has been various changes. Mobile connectivity has increased, and the biggest part is the size of Indian market is very big. So there are a lot of issues with respect to various kind of things like education, a lot of scope for growth. Then like e-commerce, delivery system, everything. There was very nascent stage and growth is happening. Indian youth have money and desire to grow, take new dimensions, new experiment with the new things. And the government policies, internet and mobile connectivities are fueling that growth. So that way it is the huge market, Indian market is growing. And the size of market is making each startup such a viable proposition that investors are also coming very well. So, this is the things which are leading to the growth of startups. Then funding is also very important. Indian funding is also growing very much. Many of the Indian business houses have created their family offices which are making investments. Then the startups which have grown now and their founders or CEOs have exited or taken part exit from the company and got a lot of money. So those monies are again coming into the startup ecosystem. They are also mentoring the new startups. So those are the things which are collectively driving the growth of Indian startup ecosystem. Then there are specific regulatory provisions or benefits which are fueling the startups. Basically, the New Companies Act has specifically defined the startup, which defines any company LLP which is not more than 10 years old and which have not crossed the turnover of 100 crores, and they are which are working in innovation, development, and improvement of product and process or services. Those are called startups in India, and if they are fulfilling these criteria, they can get themselves registered with DPIIT, which is the Department of Industrial Policy and Promotion, and then they can get various other benefits of the government policies. So what are the benefits? One of the benefits is the tax benefit. They can take 100% tax exemption for any of the 3 out of 10 years, unless till the time their overall turnover goes beyond 100 crores. So this is their option when they want to take the benefit of this tax break. And this tax benefit is available to all the startups which have started their operation, incorporated on or after 1st April 2016 till 2022, which is now extended till 2023. Then there is a specific exemption from long-term capital gain, which is also helping to first generation, to investors which are basically seed investor and they want to exit at the second stage. They can take the benefit of the long-term capital gain. Then there is a specific exemption from the requirement of fair market value, because many of the startups cannot justify the valuation, but they are getting valuation. So generally, if a company is valued X and it is getting more than X, then the extra money will be deemed to be an income and taxable income in the hands of the company. But this was a big problem for startup companies, because valuation as per income tax formula would not be matching the investors' perception and valuation. So it was a big challenge for the startups, and government has considered this fact and they have given a specific exemption. So then there is a specific exemption to individual and HUF on long-term capital gain if they are registered as MSME and fulfilling certain conditions. Then there is a specific exemption from the compliance of 9 labor laws to startups because for early age startups it is very difficult to manage their compliances, and government has considered this fact and given relaxation from the various acts like Industrial Dispute Act, Trade Union Act, Building and Construction Act, etc., many of the acts. So these are the basically payment of gratuity, contract labor. All those acts are not applicable to the startups registered for first 3 years. Now we should talk about what is the life cycle of this startup. When and how, at what stage it will be considered to be a startup, and what are the stages journey of a startup. So startup journey starts with an idea. So first thing is idea, generation of idea to an entrepreneur. So idea and entrepreneur is the key to start in a startup. One person thinks that there is a problem. This problem can be resolved by doing something, which may be many of the methods, maybe through technology or through other means. So the idea, the problem, and then its solution. Then a minimum viable product need to be created. So that is the second stage, where a model idea is converted into model, business model, and then business model is tested in the market and seen as whether it is fits to the requirement of the market or not. Then the stage of scaling comes. Here, money fueling is very important for the startups. If the startup keeps getting money, they will keep growing. If the supply of money goes, then there is a very difficulty to grow further. And after getting those money is coming, then those investments start getting fruits, and the company becomes mature company. So here the status of startup should have gone, but generally, depending upon the life cycle, this is considered to be the mature phase of the company, where the company start thinking of going to the public through IPO and giving exit to investors, which have invested in the earlier level. So this is the life cycle of a startup. And for each startup, each stage of startup, there are various challenges and various if the investor is coming, the valuation methods will be different, challenges will be different. So investors are also different. In the first stage, there is a seed funding. Then the second stage, there will be venture capital funding. After that, there will be private equity funding. So after that private equity funding, there may be one or more many series of private equity funds. And then the company becomes a mature company to go to public and raise money from the public at large. So that the valuation methods would be discussed by Sanchit after my presentation. So process of raising funds and valuation. So how to raise fund? It is said that the and a startup should not raise money unless it is absolutely necessary, because in the beginning there will be no valuation. It will be very difficult to justify the valuation. So if the entrepreneur start raising fund in the early stage, then he might lose the control or a major chunk of equity in the beginning. So it is always advisable to run at the minimum level of investment. So right kind of choice to make investment is very essential, and assessment of need of the funding is very much essential. So if that assessment of funding is done and it has become necessary that certain amount is needed to start even to grow further or start at least, then the assessment of the investment readiness is also required. So what is necessary? The model should be in the form which can be showcased, which can be presented to the investor, and which can be due diligence can be checked. So all the corporate structure, capital structure, everything is proper, and then anyone can come into the company. Then the next stage is to preparation of pitch deck, which is very, very important. It is like a story about the company, about the idea, and how and what it would do, this startup would do, so that it can attract an investor. So that is another thing, that the pitch deck, which is the first document which goes to any investor community and for raising the funds. Then investor targeting, which kind of investor we should take at any stage. That is very important. Selection of right kind of investor is very important to fuel the growth of the startup. If the startup is connected to this community, this kind of business community, he may help in the synergies, various kind of inward out growth M&A activities and all that, funding activities, and he can convey to other kind of investors to bring right kind of investors in the further growth. Then the diligence process will start. The interested investor will carry the diligence. Proper diligence will be done, so that all facts which are shown in the pitch deck is proved through the diligence process. Then if the diligence is successful, then formal binding term sheet is signed, and then regulatory aspects come. So there will be requirement of regulatory evaluation, corporate actions like board resolution, shareholders approval, etc., for issuance of shares or other securities. So this is the whole cycle of fundraising for a startup. So what is the requirement of valuation of a startup? So one is internal, another is regulatory. So internal valuation is basically for the planning purpose, for understanding the price at which we should startup should raise money, what kind of instruments should we use. Those things are important, and for that valuation is very important. So valuation can be done, that will be done through internal. Company has to, or startup has to make a formal business model. Then those business model will be converted into financial model on a spreadsheet like Excel, with all the assumptions, all the risk factors, comparables, all that things. So that will be the business modeling, and based on that, valuation will be done. So that will be the transaction related valuation, which is presented to the investor, or investor also sometimes get it done from their side and then offer certain price for certain percent equity or stake in the company. Another aspect is the regulatory valuation. So whenever a company is getting money, it need to get valuation done, and that valuation need to be by a registered valuer in India. So a registered valuer is a person who is registered with Insolvency and Bankruptcy Board of India, and which is governed by Section 47 of the Companies Act. Then there is a requirement under income tax to determine the valuation is fair and reasonable. So there is a requirement of Rule 11 UA 2 of income tax rule, where the valuation is done, which is the minimum valuation. Then in case the fund is coming from outside India, obviously the FEMA related valuation would also get attracted. So those are the basic kind of valuation. First one is the actual valuation. Other two are regulatory certification of the price. So that is done. So importance of financial model in case of business valuation is very important. Right kind of financial modeling is done so that investor can be convinced, and it can be discussed and convinced, presented to any person. So what kind the company need to carry a detailed forecast of its business performance for next certain period. Basically it will the projection would depend upon the past performance, if there is any. If there is no, then assumptions are created, and based on those assumptions, cash flow statements, profit loss account, income statement, balance sheets, all those supporting documents are created, and based on the detailed financial model is created. Those models are very, very critical for valuation, for convincing the investor, because its assumptions and its growth, whatever growth is being shown, should be reasonable, can be satisfied, and can be proved by the entrepreneur that they would be able to achieve. If it is totally Excel based without any supporting document, it would fail. So it becomes very, very, very critical aspects. What are the need and benefits of the financial modeling? So financial modeling, basically it would give in-depth understanding of the business, because numerical, it is basically the story of the startup in numerical form. So it shows what is the gross margin, what is the PBT, ROE, ROEC, growth rate, fund requirement at various stages, and what valuation should be expected at one point and another point when the investor want to exit. So budgeting is there, cost estimations are there, and it will help the investor to take decision whether, if he is entering a company at one moment, when he would like to exit, what valuation he can expect. So that is very critical. Then if some M&A activity need to be done, this becomes very, very important. Then identifying the source of cash flow would also help, because what is the right combination of equity or debt, that would also depend upon the cash flow estimations. So those becomes very, very critical. So if there is sufficient cash flow, then company can take a risk of raising debt funds, because servicing of debt is possible. But if that is not, if there is a cash burning continuously, equity would be the only source which can be raised, because debt cannot be deferred. It will have to be paid. So those things are very, very critical, and hence proper business modeling, financial modeling is critical. So how to create a business model, financial model for a business? So basically we have to study the historical aspects and make assumptions based on the growth story, what growth rate we can achieve. So considering the market size, we have to analyze the market size, what percentage of the market size this startup can capture. What is the relationship between the revenue to expenses? How much percent of the revenue can be used as expense? If there is a gap in the revenue and expense, then obviously there has to be equity infusion to plug that gap. Then what will be the finance cost if we are borrowing through debt instruments? Then what will be the non-cash expenses like depreciations, which will help to grow, which will be available for further growth, but which will be cost to the capital for the balance sheet purposes. Then projection of income, projection of balance sheet, projection of cash flow. All those are second step, and then their sensitivity analysis and various scenario. We have to, because it is a startup scenario, we have to see what is the best case scenario, what is the worst case scenario, what will be the reasonable scenario. So those projections need to be vetted on those grounds, and based on that, formal business business model will be created, and then valuation can be carried. What investor looks at. So investor looks at the financial model and the valuation aspects based on to understand the company's financials, to understand what is the fair value at which company's shares should be taken, and every investor has certain exit requirement or exit intention. So if they want to exit after 3 years or 5 years, what return he can expect, that is the thing. And then considering the model of the business, what are the risk factors he would build into the system, so that he knows that even if there is a risk, he can achieve at least the bare minimum return which he is looking at. Then what is the suitable capital structure? That is also very important. If the company has not shown its performance, then obviously investor would like to get less riskier instrument, which gives him at least confidence. Whereas on another side, the founders of the company would like to give, if in case of non-perform achieved company, they would like to take investors in non-equity type of instrument, which gives percentage at a future date. Considering when the achievements are there, then dilution should happen. Otherwise, so this mismatch need to be plugged and matched during the negotiation for investment. So I have broadly discussed what investor prospects with respect to startup investment and Indian economic ecosystem with respect to startups. Now Sanchit will discuss what are the methodology and approaches we apply or generally applied for doing the valuation, and a few case studies to explain it better. Thank you very much. Sanchit, you please carry on. Thank you.
Thank you. Thank you, sir. So broadly, I will consider now the methodologies that we take into consideration for doing any valuation, and particularly startup valuation. Next slide. Yeah. Next slide, please. Yeah. So with respect to the international valuation standard, as you can all see, there are broadly 3 approaches: income approach, asset-based approach, market approach. There are certain other methods also to do the valuation, which I will come to later on, which are to be taken into consideration on case-to-case basis. Let's take into consideration first the asset-based approach. The asset-based approach or the cost approach derives value from the combined fair market value of the business net asset. This technique usually produces a control level value, meaning the value to an owner with the power to sell or liquidate the company's asset. For that reason, a discount for lack of control may be appropriate when using the cost approach to value a minority interest. So this approach is particularly useful when valuing holding companies or asset-intensive companies or distressed entities that aren't worth more than their net tangible value. Coming on to the next approach, which is the market-based approach. Market-based approach consists of various methodologies: comparable companies, comparable transaction, market value method. So this approach bases the value of the subject business on sales of comparable business or business interests. It is usually useful when valuing public companies or private companies large enough to consider going public, because data on the comparable business is readily available. So we would take into consideration the peers value, make adjustment on a similar company, and then value the company. Under this approach, the valuer identifies recent arm's length transaction involving similar or public or private businesses using their pricing multiples. Coming on to the income approach, when the reliable market data is hard to find, the business valuation valuer may turn to the income approach. This approach particularly considers the future expected economic benefit, generally the cash flow that a company or a startup will be considering down the years, into a present value. Since this approach bases value on the basis of business ability to generate future economic benefit, it is best suited for established profitable business. However, we can definitely use this for startups as well. Of all these 3 approaches, as per the International Valuation Standard, there are a few other methodologies also that we consider, such as First Chicago, venture capitalist method, price of recent investment, contingent claim valuation, etc. on case-to-case basis. To give you a broader sense of statement, there is no universal formula that exists to value any company. Therefore, it is essential that a valuer has to explain or justify any specific method that he or she uses. Coming to the next aspect, which is methodologies that are being used for startups. The three approaches that I discussed, that are the asset approach, the income approach, and market approach, are still valid. However, startup valuation is more about understanding promoters and management's background, experience and vision, future potential of the business, the human resources, the technology, the competitive landscape, the profitability of the success and the failure attached with the startup. In a way, startup valuation also involves validation or review of the business model, which makes it complicated vis-a-vis the traditional valuation that we do for already established companies. So I can say that it can be concluded that while valuing a startup, the experience of a valuer plays a significant role in concluding whether that is the fair value of the startup or not. The other methods that I was talking about, the first Chicago method, the Burkas method, the scorecard, cost to duplicate, venture capitalist, risk factor summation, these are some of the other methods that we use to value startup on the basis of preferences, technology, and on case-to-case basis. Let's just look at a few methods that we have taken into consideration. Next slide. Okay, so let's talk about the first method, that is the first Chicago method. The first Chicago method entails three different projections, particularly success, failure, and survival. A profitability estimate and a probability is assigned to all the three cases. And all in all, we will do the valuation thrice. That means keeping in mind a success factor, a survival factor, and a failure factor. The projected sales, as you can see in the diagram, projected sales in all the three cases are very different. The success being the highest, survival being on the mediocre range, and the failure being is totally conservative way. And so we have calculated the adjusted EBITDA of the company accordingly in all the three cases. We have given industry adjusted average to the same and calculated the concluded enterprise value in all the three cases. We have given also a probability of each estimate in this case, with the survival being 50% and the failure and success being 25%. In this way, we have weighted average all the three cases and calculated the equity value of the company. This method eventually results in a separate valuation and pricing of each outcome. These heads are then averaged and the weighted average valuation is determined. And we conclude the equity value. This is how first Chicago method is taken into consideration. The next method, that is the scorecard valuation. The scorecard valuation method is a more elaborated approach to the subject company valuation. It starts in the same way as the first Chicago method. That is, you determine a base valuation for a certain set of criteria, except those criteria are themselves weighted up based on their impact on the overall success of the subject company. Besides the normal valuation of a company, the scorecard method considers the qualitative scores of various factors, specifically being management, traction, competition, current environment, need for additional investments, all of these. The weighted average value is then recommended as the value through the scorecard methodology is calculated. You can see in the diagram that weights has been given to all the qualitative factors and a factor has been calculated in the end. A pre-money equity value has been calculated through first Chicago method. That was the base. And then we have applied the scorecard factor that we have calculated. And that is how we have calculated the adjusted equity value through the scorecard methodology. Coming on to the next method, the Burkas method. So the Burkas method is again very crucial in startup valuation, and it gives five crucial areas on which a startup has to value itself, and it indicates a value ranging from different parameters. Five such factors are: a sound idea, which is the base of the startup; the quality management team that makes the complete human resource for the startup; the prototype, whether it's a service based or a manufacturer; the strategic relationship that it has in its network; and the product rollout or the tech sales. All of these are considered, and sum of all the values results in the pre-money valuation for the startup. For instance, if a valuation for a startup has come out to be as $6 million, then all the five areas would get up to 20% of the 6 million. That is the five factors that we have considered. That is the Burkas method. Next slide. One such method called the venture capital method is very desired in this era of private equity and venture capital, where they follow a 6-step methodology in any valuation. First, they estimate the investment that is needed by a startup. Second, forecast that the startup provide in its financial, that is the projected sales in the next 5 years along with the terminal value. Third step, determining the timing of the exit. So whatever investment that they're going to be giving to the startup, they time it accordingly and calculate a payback period on what time and in which future date that they will take an exit and through which route, whether it would be through an IPO or M&A. They calculate the multiple at the exit. Whatever the multiple they predict for in future, they calculate that. They discount that future multiple to the present value at the desired rate of return that they require. And the last step, they determine the valuation. After that, the ownership stake that they require. So this is how the venture capitalists value a startup. The next aspect is the challenges faced for valuation of startup. If you look at, there are various valuations challenges that as a value that we have to face. First, the lack of historical data. Without a financial history, it is very harder to make reasonable assumptions about the key value drivers, such as the growth, efficiency, or the cost structure of the startup. The second being hidden cost in the forecasting. Sometimes startup founders hide some cost in the projections. For example, founders agree that they shall not be taking salary, but down the line, they start taking salary, which reduce the profitability at an increasing range once the specific milestone is achieved. Third, the unique product and business model. As we all know, we have seen startups in almost all industry, in all sectors. It is very difficult to find the positive sides as well as the negative sides, and the sustainability of the projections of such business model, which has to be benchmarked against the proven business, which becomes really difficult while forecasting. Fourth, complex capital structure. So startups depends on various private investors in forms of seed funding, angel funding, the claim on the right of shares issued at each round of investments, which makes it a little difficult in valuing the startup. Fifth, loss making or no revenue. As many startups are still in the ideation stage, and even after the startup has been launched, there is no revenue for the next 1 year or 2 years for that matters. It becomes really difficult to value a startup in that sense. Fifth being illiquid investments. The startups had various illiquid investment assets that they purchase for their future. Speculative and aggressive financial projections. As the entrepreneur makes sure that it has to raise maximum funding, they make their financial projections on a very optimistic and aggressive level. The high risk companies, startup being a new segment where they enter a new territory, there is a lot of risk involved with respect to the financial side, the competitors. It is very difficult to adjust the risk accordingly. Limited capital infused by the promoter and the high dependence on the external source of funds, as most of the startups usually depend upon angel investments, seed investments, and doesn't involve in putting their own capital. Next slide. As I've discussed some challenges in the startup industries, there are certain specific industries that we have to look into while valuing. And these industries, the multiples differ from the very traditional approach. Why? I'll give the reasoning on that matters just shortly. But if you can look, there are multiples like EV to revenue, EV to subscriber, EV to reserves, EV to production, EV to capacity. Next slide, please. Market cap to book value, EV to FFO, PE, PEG ratio, and such others. So over the years, the valuation experts and valuers have distinguished patterns in the selling price of the business and the financial uh, ration of the relevant groups. These patterns and industry-specific multiple determine the current value of the company. Industry-specific multiples are the technique that demonstrate what business is worth. As different industries have different revenue models, it is very hard to measure all the industries on a similar certain specific multiple, that is EV to EBITDA or PE ratio. As they have different models, different methodology and different multiple has to be applied to that specific industry so that proper worth and fair value can be determined. Companies that manufactures have one set of value metrics and broadly similar accounting standard. However, banking industry may be different as they are highly regulated. Same goes for small oil and gas producers, which have remarkably different accounting standards and are valued differently. The AI technology and the internet bubble, which gets crazy valuation because of the growth possibilities, are hard to restrain conceptually and because the growth opportunities are very much in them. Same goes for their marginal cost of new client is negligible. All in all, what I would want to reiterate my point is that same metric cannot be applied to all the industries. Hence, certain specific metrics are used, as I've just displayed on the screen, for different industries and different methods. So accounting constraints are there, regulatory regime, all of these affect the valuation. Apart from the technical aspects, the revenue model, goods and services that are provided, nature of the industries also play a role in it. To take into consideration, I would want to choose three industries on how we value certain specific three industries and then followed by case study. Let's look at e-commerce first. The critical aspect of e-commerce business include order fulfillment and inventory, reliable product source, product uniqueness, branding, organic traffic, and product concentration. The most effective way of valuing e-commerce business is to use valuation multipliers. Valuation multipliers reflect how much the company would be worth. Four such multiples I've just listed. First one being the revenue multiple. So where the basis of the valuation is a function of an earned revenue based on the acquisition price of the companies in the similar market, we use revenue multiple. Where while this provides a useful point for reference, this methodology can certain times be tricky as it doesn't account for variation in business model between companies. It doesn't measure cash flow. There is no consideration for difference in risk between the comparable business. As I did tell you in the beginning, that there is no universal formula and everything has to be relied on the judgment and subjectivity of the valuer. That is why in every valuation report, any method that is being chosen has to be justified properly. Also, the method that are not chosen has to be justified as well. Second being traffic multiple. Traffic multiple is fundamental to any e-commerce business because without traffic, any e-commerce business would not generate any sales. A standard traffic measure could be called as a revenue per user. So which shows how much each visitor generates in sale. It stands to the reason that traffic plays a vital role in the valuation process of an e-commerce. Third being the earning multiple, where the e-commerce business has a history of profitability. An earning multiple is a convenient way to arrive at a company's valuation. The exact multiple applied in a valuation is likely to be a function of factors such as the revenue growth, consistency, scalability of the operation, and the complexity. Fourth such approach is called the discounted cash flow analysis, which is a part of the income approach. Arguably, that is the most robust method. However, it is rarely used by founders due to the complexity of the modeling and the communicating the many business assumptions and the adjustability of the risk factor. The next approach, which is the gross merchandise value. Increasingly, we are seeing a significant number of early stage e-commerce companies presenting valuation for fundraising based on their GMV, which is the gross merchandise value. This GMV is the total value of transactions that happens across the platform of the e-commerce. These businesses are generally in their initial stages where it is too soon to make an assessment on the basis of revenue and profitability because of a lack of consistent time series data. GMV is basically not to be misunderstood with the revenue, as revenue would be different and gross total value of the transaction across the e-commerce platform would be different. As whenever e-commerce platform usually take into consideration revenue, they have to give massive discounts, as we have seen in the case of e-commerce. Next slide, please. Let's look at valuation of specific industry in the case of AI and VR or any tech-based startup, be it blockchain or any other. As I told you in the beginning, there are the three approaches: market approach, income approach, and asset approach. For these new age companies and tech-based startups, income approach, that is forecasting of the future cash flows and then discounting it to the present value, would be considered as the most dynamic approach, because since these startup companies are not very asset heavy, they are not relying on very asset heaviness. Secondly, the market approach cannot be applied because such kind of peer companies would not be there, which can be used as a benchmark in valuing this company. In such a case, focusing on the future forecast is the only reliable method that we can take into consideration for valuing the company. Third, next slide, please. Valuation of the loss-making companies. As we all see that there are many loss-making startups garnering huge rounds of valuations, becoming unicorns every other day, and still showing losses in their financial statements. In such a case, multiples like PE, EV to EBITDA cannot be used. Reason being, when the earning is negative, such multiple doesn't hold any value and doesn't reflect the true value. In this case, if we do have to follow the multiples based approach, market capitalization to sales would be preferable. But secondly, what I would want to focus is the DCF based methodology, which is being used in valuing the company with the negative earning, as they are more predominantly focusing on garnering more and more revenue, the cash flow that they're going to be generating down the years, and probably in the terminal years when they would be actually be profitable. DCF methodology is very robust and widely used in valuation of a loss-making company. Two more methods that are there are industry-specific multiple and price-to-sales ratio. However, still not very reliable. As I just mentioned, DCF is usually the go-to and preferred method when valuing any loss-making companies. As you can see, OYO, founded in 2013, is a multi-chain hospitality which has a valuation of around $9.6 billion, showed a loss of approximately 4,000 crores, which is $526 million recently. Flipkart, you can see it has shown a loss of $382 million, which is approximately 3,000 crores, with a valuation of $37 billion. You can see PhonePe has shown a loss of 1,700 crores and still at a valuation of $5.5 billion. Paytm showing a loss of 1,700 crores again at a valuation of $16 billion. Unacademy, whatever the common point in all of these startups are that they are showing huge valuations, yet showing losses in their financial statements and still raising more and more funds. Let's look at a particular two case studies here. So as you can see, in the case of Delivery, which is India's one of the largest and fastest growing fully integrated logistics services player, has a valuation of $4 billion. it is still showing a net loss of 900 crores, 9 monthly, and reporting a revenue growth of 82%. The multiples when we do a valuation in such a case are EV to sales or price to book value. You can see that it hosts a EV to sales of 4.8 times, and so does the price to book value at 5.2 times. And in the future rounds of funding, whenever it will be, it would still be showing losses in the coming years and yet garnering more and more valuation. The main criteria in such a case is that the investors, why do they invest even when the startup or the company is showing net losses, is in the hopes in future years, once there is tractions of user, they would be showing profit and they can command a premium at that moment of time. Next. Valuation of Cartrade. You can see Cartrade is a multi-channel auto platform, again hosting a valuation of $1 billion, being a unicorn, has a multiple of price to book value at 4.4 times, EV to sales at 29 times, and price to earning at 73 times. The revenue of operation is $37 million and yet showing a net loss. So what we can understand from this is that losses doesn't have any effect on the valuation of the company. Losses are temporary in the investor's eyes, because down the line they feel that they can earn more and more value, they can command a premium in their specific sector. So that is what all about the case studies is. Thank you, everyone.
Thank you, Sanchit. Thank you very much. So now we have few questions that we will give answer after Mr. Malu. Maluji, now you have heard Manoj, you have heard Sanchit about the technical part of the valuation. Now you tell us the industry experience, like you are interacting with so many people. You are representing both new age economy company and the old age company, and traditional company versus the new age. So what is your suggestion to the startup? What you want to give them a message, what they should do? Because the problem is they don't have money initially and their valuation is also less, but the business can be scalable. But they want money initially, and that time everybody wants the valuation and they want the large chunk. So give some advice and your experience. Over to you, sir.
Thank you, Pawanji. Mr. Manoj and Mr. Sanchit has already very nicely covered the subject, and you had already overviewed these things. Particularly in my view, this particular year 2022 is going to be the year for startups. 21, we have seen there are around 42 unicorns has come up, and we have already crossed 202. I am thinking that we will be somewhere crossing about 175 unicorns. This is an area where everyone is thinking about startup. May it be the old era companies, may it be the new companies. I've seen the trend that every promoter thinks that at least his new generation should enter into the startup areas. So this has become very important. And if we see, we are in Delhi NCR, and after Bangalore, we are the number 2 in the country. And the growth rate, if we see 20 versus 21, we have grown by about 7 to 8 times in this time. And all the professionals are also ready for this startup ecosystem. Government has also extended various helps to the persons. How I perceive this startup system, I have my own definition on this part, and I hope at the end you all will agree on this part. Here the S starts for speedy scaling the operations in a systematic manner. So if you want to have some startup, one must understand that what this S stands for. It is speedy scaling of the operations in a systematic and sustainable manner. So if we can take care of, if we can respect all these S, then we can definitely have a startup. Then comes is the T. T stands for transformation of the processes and practices. Transformation of the entire processes. We have to create another sort of a system where we can really reduce the cost we can transform the practices, and there is the need of burning the money. When we say that not many startups, they are in losses, but see their ideas. Their ideas is someone is burning the money for 2 years, someone may be burning the money for 5 years or even 10 years. But at the end of the era, they are going to convert into the case. The valuation methods, when Sanchit and Manoj was explaining, at the end, it is the case discounted flow method, that how much of case at the end of the day you are going to get. A here stands for aggressive automation of the processes. You have to, everyone, in the industry, we do automation, but here it is, aggressive automation of the processes. Then R here stands for raising of the funds in timely and appropriate manner, which is very important, that when you have to raise the debt, at what sort of a risk you should take, since it's a game of risk and return, high risk, high return. And therefore, and you have to also see that what sort of a stake has to be diluted. So basically all depends on that how much of a professionalism in due course of time you are doing, how sort of a sacrifice you are doing for that idea. So this is the meaning for R here. The T stands for technology adoption, robotics, and upgradation of the processes and the system. You cannot reduce your cost, you cannot speed up the things unless otherwise you take care of about the technologies. Then U is very important. Startup, U is very important. You must have a unique idea, whether it is a unique service idea or unique product idea. Then that idea, how much it can scale up. Someone may ask the question that when we should raise the money. So one has to see that how, up to what stage you have remained unique in your ideas, and how uniquely you have been able to convince and communicate to the investors. So this is very important aspects of a startup. And P stands for product fit. So what sort of a product you are preparing, whether it is a market oriented or it is channel oriented or what sort of a thing. So all this startup itself give us answer to all the things, that how we have to run up in all the manners. This means raising of the raising of the funds which you asked is very important here in startup. The raising, there are various instruments, and we all know that banks are not going to fund the losses, and therefore the issues remains with us is the equity products. These equity products may be convertible products, maybe some sort of FCCB or these sort of products. And for this, the valuation is very important, that at what valuation we should raise. If in the initial, the valuation may be 10 million for a new startup, and if at 10 million, if he is diluting the stake of say 50%, then it is not going to be a game. So what the person has to do is speed up their ideas. Ideas has to be unique, and one has to work day and night. Already a system has built up in the country. If you see the recent trends, the most lucrative offers they are coming to the campuses is from startups. This is one side. Another side is, if you do a market survey, you will find that the new generation wants to go as against joining, this all professional courses, chartered accountancy, company secretary, engineering. The persons, maybe even directly from BCom, they are going that side, or maybe after doing these professional courses, as against joining the corporates, they want to do on their own. Why the things are scaling up in a good manner in India? India, we know that we have an entrepreneurship, and therefore it's a good time to test the entrepreneurship test, the speed which is required, and the organization setup, is very important here. Our teams has understand our various aspects, means including the government. Government is also promoting. In Delhi, you will see that lot of slogans, lot of advertisements are there. Delhi is going to be, government thinks that it is going to be capital for startups. different incentives are given by the central government in the Income Tax Act, etc. also. So, this is going to create a good atmosphere in the country, and raising of the capital depends on your ideas. Lot of venture capital funds are there, and there are reputed funds. Reputed funds are there, like Sequoia, SL Partners, Tiger Capital, Fidelity, Indo-S. These all are there. There are the persons, investment banks who also market these things. Good valuers are there. Valuers are there. So we should take the help of all these professional persons to guide. I know that your firm is also having a separate wing to raise the funds to help to the startups, and really this is a good work you are doing for the society. If we see that which are the areas where these investments are going much, so if we see in that, fintech is one of the largest area, then edtech and SAS. These are the three topmost area, but these are not only the areas. There are different things. There are different uniqueness by which the funds can be raised. So it is e-commerce. Within e-commerce, it is B2C, it is B2B, it is D2C also, direct to consumers. So these three channels are there. Health is also there. Logistics is also there. Food tech is also there. And funding is not a problem. Even if you see all, whether it is Tata's or it is Ambani's, or they are having their own family offices and they are taking the ideas, they are funding it. So it's very important to ensure valuations, timeliness of raising of the funds, and the speed has to be there. We have seen many cases of startups that they have not been able to maintain the speed. I will not name them. They have not been able to technically upgraded. They have not technically upgraded. They have not been easy to use, and that's the reason of their failures. The unicorn concept, we have just completed 102, and I'm sure that India in next 5 years will be crossing 1,000 sort of a unicorn in this area. All professionals, this gig economy has also become a base for good startups. Means the shared services are available. No one can have full-fledged CFOs, but a CFO can do for 4 or 5 startups. They can guide them. There are, weekly meetings of startups. Those sort of platforms has come up. So they are really helping. There are M&A transactions also happening in this space. So this is a second stage, generally in any of the industry. So consolidation is happening. M&As are happening. About 250 large M&A deals has been reported in last calendar year 2021. So with this, I think we should invite the question and answers. So anything relating to me, I will try my best to answer that. Once again, thank you very much.
Okay, thank you very much, Maluji. Thank you very much. Now, whatever is left out, we should discuss here and come out with the solution. So I'm taking some questions which are there. Sanchit, could you please elaborate a bit on first Chicago method?
So as I told you about first Chicago method is nothing that considers 3 cases, 3 scenarios. The valuation is done as per all the 3 scenarios. The weightage is provided to all the 3 scenarios, which are the success, failure, and survival. The profitability estimates and the probability assigned to each case calculates the valuation in every outcome, and these are then averaged out and combined together. That is what first Chicago method is. It is more or less an extension of how DCF methodology is done. It is just an extension in a more refined format and a more fair valued way of doing any DCF methodology, considering all the 3 approaches.
Manoj, you want to add anything else?
Yeah, sir. So as Sanchit has rightly said, First Chicago is a method which is an extension of the discounted cash flow. Basically, the company is valued based on the cash flow, present value of the cash flow only. However, because there is no certainty or there is huge risk or expectation of deviation in the projections, we make three kind of projections. One is very conservative, which is in case company is getting failed, what will be the situation? So bare minimum turnover in each of the year and bare minimum profitability and cost is considered. This is the bare minimum valuation. The other one is reasonable kind of valuation, and third is success, what the entrepreneur is thinking. So first is the free flow valuation as the entrepreneur thinks. All the three projections we do the valuation, discounted cash flow valuation, and then we average these three methods out, average out, and average value is taken to be the conservative approach to make investment. And this is widely used by venture capitalists or maybe angel investors, because it is for early stage companies basically.
Okay. Manoj, how to calculate multiple for private limited companies?
It is not about the private or public limited company. It is about the industry or business for which we are doing. So we have to select the right comparables. If we can get right listed comparables, then we will take their financials. And based on that, we will extrapolate our company's financials and see what is the reasonable value we can expect. So as in case we get the direct competitor or direct alternative to the business, then we will take that. Or then we will make adjustment with respect to size of the company, size of the revenue, age of the company, because every stage has different financial dynamics. So all those adjustments are done, and based on that, we determine the multiple. Which multiple should be determined? Used, it may be EV by EBITDA, which is a very commonly used method to determine the enterprise value of the company. And then we will adjust the debt from the debt and liabilities, and that will be the equity value of the private company.
Okay. Maluji, this question I will ask others also, because valuation is not a science, it's an art, and sometimes it's a art or sometimes it's a science, not art. So if there are three valuers sitting, there will be four valuations. So the question is, which is the best instrument for giving shares to the investor and its merit and demerits?
Pawanji, this depends on basically the type of business which we are evaluating. If it is an early stage investment of the business, is a mediocre sort of a stage, or it is a full-fledged like as a IPO sort of a stage. So if it is the third stage, then more we will be nearer to the discounted cash flow. And if it is at a stage number one, then we will see number one importance is what sort of a turnover or a footprint or scaling of the operation is possible. Along with that, what is the probability of converting into the profitability, and in what sort of a time? So it will be more on the examination of the bases of the assumptions which has been taken. So this way, we can't say that we will go with one approach. At least 2 or 3 approach will go together, and at the last, we will compare it with the other transactions or the deals which are similar in nature, which has happened in the past or going on in the market.
Manoj.
Yes, sir. So I think the question is relating to equity structure of the startup, right? Or valuation method. If it is equity structure is as Malu sir is rightly said, we have to see the stage of the company. In case the company has already established its business, then direct equity may be a good idea. Giving dilution of equity may be a good idea. But in case it is not a mature business and it is a startup like situation, then convertible instruments are a better instrument, which is based on certain milestones would get converted at the fair valuation. So it is win-win for both. The investor also ensures that he gets a sufficient number of percentage of equity to get his IRR, expected rate of return, and obviously the founder and the shareholders are not get sorted and get less diluted without sufficient valuation. So this is the balancing which need to be done, and obviously considering the risk factors, negotiation happens on those aspects, and based on the structure related. It will also depend upon the investment, whether it is coming from India or coming out from outside India, and whether there is a possibility of giving the cash flow in between, or it will happen at the end through IPO or through sale to another startup or merger with some other company. So those things are factors. Based on that, decisions is made.
Sanchit, your view, which is the best instrument?
So it depends on case-to-case basis. To say that which is the best instrument won't be appropriate according to me. I just feels that as an investor, being involved in the equity share capital would give them more and more rights to control the company, but it might not be for the entrepreneur.
Okay. I think the person who has asked question, this is the normal thing when you are starting some project and you have a conviction about that product and people are saying this product will run. And if you have a mentor and he's also telling you this is a good, so you should not take money. I'm not talking about the instrument. You should not take money till the time you are not in a position to bleed. You should take money when you are really out of pocket, because what is happening when you create a business, when you have an idea, the value is say 10. When you are adding something on paper, value is 20. When you are doing something, value is increasing 30, 40, 50. But that time, if you are taking money, your valuation will be less. So you should try a comprehensive model, workable model, visible model. Then you ask money from anybody. Otherwise, what is happening today? You are coming out with a model and your valuation, which is somebody is giving 1 CR and you are giving 50%, that is a 50 lakh rupees. You want 50 lakh rupees, so 50% shares. It is not a situation where you can survive in future. So what Manoj has said, that one is, which I have said, that you take the late money, you try to get money after the confirmation of this, your project, then you take the instrumental, which is convertible on the milestone. So what is happening? This is a combination of loan and equity, and that loan is also converted in equity on a higher price. So you have to take this formula. Maluji, why EdTech startup facing problem in working? Recently, many EdTech companies hired all of their employees. First, I'll ask you, then Manoj and Sanchit can add. Why this is happening? Because
I think this Manoj, I will pass it on to Mr. Manoj.
Manoj, this is not a question on EdTech. This situation can come for any companies, any industry. So there are so many companies are coming. Today, I just told you Physics Wala that got it will become unicorn, and other EdTech companies are closing. What is the reason?
So it happens to many of the businesses. Startups are bound to fail. It is well established principle that at least 90% of the startup fails and then only 10 survives. That is the thing. But at what state a startup fails, that depends upon the their model, their fast turnaround, agility, and the possibility and capability to raise funds. So many of the startups are raising funds and they are burning cash to build the size, increase the size continuously, upgrade in the business, marketing aspects, technology aspects. But if due to any reason their fund flow stops or delays, then obviously they don't have any option but to reduce the size. And this is the reason why we have seen about Vedantu and others. They are retrenching many of the persons because they have already got we are not getting the fund at the right time. So to survive, it is important that they cut down their cost, and they are doing so. So we have seen like Zomato and Swiggy's are growing, but Food Panda gone. It was also similar to a good company, right? Similarly, Snapdeal gone, and Flipkart and Amazon is growing very fast. So it happens in any of the startup space. There may be disagreement between the founder and investors, or in existing investor and other investors at the time of second round of funding, and this dispute may delay the fund flow. And if the fund flow is not coming and the company is in loss, So how to fund those losses, how to keep growing, keep paying money to employees for marketing, for business development, and for operations. So that is the challenge. This challenge is for every startup. So timing, right time investment, and right time, right decision is very, very critical.
Sanchit, do you have any view on this at tech?
Apparently, yes. So as we all see that these startups are very high risk companies, and with almost all these startups in the initial stages showing losses in their balance sheet, they won't be able to survive without fund or without raising any fund. And human resource is a very big major chunk of cost that relies upon these startups. If the fund is even delayed for a month or a 2 month, they can't, like traditional companies, keep on having those human resource in their company. They would have to let them off at certain point of time, as we have seen in so many companies in US as well as in India, where they had laid off almost 100 and 100 plus employees. The sole reason was there, they were not showing profitability in their balance sheet, and there was no fundraising in the coming time. And for that, to avoid any investor backlash, or for the company to go into bankruptcy or insolvency, the only survival option left with them is to cut off its own arm, that is cut off its own human resources and lay them off. I know it's a harsh call, but still.
Okay, so this is absolutely right. This is happening because everybody should understand two basic principles. One is these startups, they are starting. If they are something different, like take example, Baiju, Vedantu, and then physics wala. This physics wala is teaching only physics, and other people are teaching multiple things. So it means that there is a market, but you have to give something different. You cannot give the same dish to everybody, and in that particular time, who will survive? The person who has a bigger kitty and bigger market, bigger people, and bigger advertisement. So that is a consolidation is always there in the word. Ola, in the Uber is there. Other companies are there, small company, which are there every part of this word. So you have to understand this point, that when you are entering into this, then you have to take the risk of consolidation. People will consolidate and bigger will be the bigger. Okay. Friends, when this issue is coming, I will just tell you, because I'm giving mentoring to various companies, you should have one mentor, number one, who has the knowledge of this market. Whenever you have some problem, they can suggest you, they can tell you how to take fund. So you are not expert in that area. Okay. Try to take the maximum advantage of others' knowledge, those who are in this area. Otherwise, you will lose somewhere, because you are entrepreneur, you are not financial guy, you are not legal guy. What the instrument, what the agreement, what are the non-compete, so many things are there where you require somebody's expertise. That is number one. Number two, whenever you are starting any business, you see who is your competitor. The most important thing is which business are facing. You may be good, your product is good, but you are not realizing competitor. Now, competitor is not a direct competitor. Sometimes the competitor can be the indirect competitor. For example, one person came to me. He told that I want to start the three-wheeler. This is 5 years back, 5 or 6 years back, somebody came. Then Ola, Uber, that came into the picture. He told me that I want to start a three-wheeler type of things like Ola and Uber doing. Idea was good, because that time Ola and Uber, they were not doing focus on this three-wheeler. But I told him that how much time Ola, Uber will take if this is business is viable. I told him 5 minutes. They will add that thing, and people, because they have a both platform, and your business will go away. And that is absolutely right. He was very bullish, and he wanted to do certain things. So you have to see that this is my business, who is competitor and who can immediate become competitor. These are the two analyses you must do when you are plunging into this particular startup area. Okay. Now, Manoj, Are there peer review of valuation of a valuer, as we see the valuation of the late has been little off towards so many wrong things happening?
So presently, there is no specific concept of peer review, but certainly because the valuation is getting regulated, more and more regulated, and it is proposed that a separate institution will be created, which will be the governing body for all the valuation in India. There will be a need for peer review of the registered valuers, but as present, it is not. Most of the cases, obviously, there are code of conduct for registered valuer and for code of conduct for merchant bankers. So they have to carry diligence and they have to give fair and reasonable valuation as per their opinion. But it is still opinion, so opinion cannot be totally watertight. It has to, there can be difference of opinion among the valuers.
Okay. Manoj, how to decide valuation methodology of a startup which is in the blockchain industry?
Sir, as discussed by Sanchit in detail, there are many methods, but the basic methods is always the cash flow, future cash flow, present value of the future cash flow. So whoever basically investor invest for the return of investment. So return of investment would come only from the company's growth, company's value, and value growth. Yes, it is a possibility that one investor goes and replaced by another investor, but the another investor would also come looking at the future cash flow. So if the company is getting money, getting revenue, profitability at a future date, maybe 10 years after that money can have a present value. There may be other factors also, ancillary factors like size of the market, penetrations, possibility of disruption. All those things are there, but ultimate basic valuation goal will be based on the DCF only. So DCF will be the valuation method. Besides that, there may be first Chicago may be applied to make it more better. Other methods, as discussed by Sanjit, it may also be applied considering the size of or stage of the company. Sorry, you are mute, sir.
Maluji, what all things that an investor need to check in a startup before investing? Like you have seen you are a big business. So suppose you have to invest as an investor, what you will see in the startup?
Very valid question, sir. So the things which we need to check, we have to invest for making money. And investing in startup is more risky. Therefore, our due diligence has to be far better than what we are investing in the regular industry. So first of all, the very important thing is the idea itself. Whether it is a unique idea, how this idea is going to work, what are the chances, what sort of a competition can be there, whether domestically or it can be internationally, what sort of a regulatory parameters are there, what sort of funds are required, what sort of a human capital is required, and what is the patience level, what is the level up to which the funding can be done. So these are the things basically we will see. Then we will compare it with the other existing alternative opportunities available to us, and then we will take the idea that we will also see that what is the time period for which we want to invest, and we will match it with reference to the best valuation which we will be getting. So suppose if the startup wants a time period of 5 to 6 years and I have a money only for 3 years, may not be I will be putting to that startup. I will go for a startup which is at a medium stage and where I can get my money and better returns in 3 years. So origin is also very important for us. Then I will also do a due diligence of the promoters. If they are in partnership sort of a thing, if they are in family structure or what sort of a structure is there, that is also very important to see it. The professionals persons attached to them, what is their commercial interest, whether they have been done with proper warrants or maybe ESOPs, those things are there or not, so that we can become a permanent investors with them.
Sir, you are mute.
Manoj, you want to, Sanchit, how valuation plays a pivotal role in fundraising?
So valuation is almost the make or break in any fundraising aspect. Obviously, keeping in aside how the entrepreneur presents its company, but valuation gives the benchmark on what rate or what value the promoter has to or the entrepreneur has to dilute its shareholding. It's a very big benchmark that he or she can use in negotiating with the respective investor, because whatever fair value of your company comes out to be, that is what will help the promoter or the entrepreneur in negotiating with the investor at the right value to dilute. So in that sense, it's almost the make or break in any transaction, whether it's fundraising or any deal transaction, M&A. Valuation is everywhere. So it is very imperative that it is done on a fair valued basis, because that is what will guide whether the transaction will happen or not.
Okay. Sanchit, you check your voice. Madam Manoj, how my voice is clear?
Yes, sir.
Yes.
How the startup manage building up and or expanding and simultaneously acquiring other business startup? So is there any condition precedent for other business acquisition, or it's just expansion strategy? Why and how VCP fund to acquire other business specific case in Baiju?
Yeah.
There
So
are accumulated losses and still acquiring many business like Akash.
right. So obviously we understand that the value of one Baiju is one of the earliest startup of India, and has grown to such a big size that has become a mammoth of edutech, right? Around $20 billion is the current valuation at which it is still a private organization. It may not be considered, should not be considered to be a startup, but because it is still in losses, not under profit, not came out from the reds. So it is considered to be a startup. But yes, now it is a mature business and it need growth. So how to get further growth? For that, M&A, inorganic growth methods are very, very important decision. So the investors which are sitting in the company's board or company, they know that it organically it may not grow as much as it is possible, and there are very good opportunities, very new generation entrepreneurs which have created a very unique models. Or there are many companies like Akash which are well established brick and mortar companies and has very good penetration in certain segment of the business. So to become a full-fledged business house, it is very important that all those existing business should be under the fold of Baiju, and that's why this kind of M&A activities are happening. And they have no dearth of cash coming as a further investment, and they can also swap equity like they have done in case of Akash. So by acquiring the Akash, they have entered into the brick and mortar business also, and that then now they have also started tuition centers for primary wing of the students. So now they are not only the edutech startup, they are now brick and mortar plus edutech. So obviously it is a two-way expansion, and inorganic growth is very, very critical for further growth. So that is happening.
Okay.
Pawanji, just to add to this, that merger and acquisitions, whether it is for industry or it is for startup, why we do the mergers and acquisitions. Sometimes we think that we are not opening a complete basket of the products, and by adding certain products, we can have our position better in the market. We can avoid competition. We can have benefits of consolidation. We can have the pricing power, and we can attract more customers. Not only this, but sometimes we found that this business is more or less similar to us, but getting lower valuations. And if we add it, then it's due to the above three benefits which I have given to you. If we add it, then it will further add my valuations. And therefore, with these principles, which is also applying in the startup era, so we do the mergers and acquisitions.
Okay. Sanchit, of late, loss-making companies are raising fund for customer acquisition. How is it?
So all these loss-making companies that are raising funds are working on just one principle, is capturing more and more users to their platform. That is what the whole idea and objective is all about. whether it's Zomato, Swiggy, Paytm, any company, any startup who is working on a loss and still raising fund is working on a sole objective that today make the user so addicted to that platform that down the line, even when they start charging, it will not be possible for the user to leave the company or leave that service. This happened in the case of Uber. Back then when Uber came to India, they were giving free rides to almost everyone, not just one. Every other month they were giving free rides to the users. And if you see today, we all became addicted to that system. We are now very much inclined towards taxi and the cab services, that whatever amount they charge. Nowadays, we are only complaining that Uber is charging so much. If it is charging so much, then why are we paying for it? It is only because now we are addicted to that kind of a service now. And that is what all of these startups is eventually going to do. We recently have Swiggy developing that 10-minute delivery. Swiggy, Zepto, Blinkit, all of these. Right now, that delivery service is totally free. You get your groceries, everything delivered within 10 minutes at your doorstep, even lesser than that. The time is not far when down the line this service will be costing us 20 rupees or 30 rupees or 40 rupees for delivery, and we will be acquired by it. We would be used to 10 minutes of delivery, that we would be okay paying that much amount. So and today they are making losses, but down the line in future, all of these companies will be profitable.
Okay.
Let us see. Their basic idea is change in practices, creating addiction to that. Yesterday only, when I was going somewhere, I was just thinking that suppose after 5 years, Google says that we will charge you for one search 5 rupees. So whether we will be able to say no to that? No. Whatever drivers you are getting, they may be so addictive that, or you will not be believing on them unless otherwise he will be starting your Google Maps.
Okay.
So this is, I think, the idea.
Okay. So the same things I was thinking. Sanchit, suppose WhatsApp start charging, what will you do?
Yeah, of course, that is the case with almost every platform. WhatsApp starts charging, or Google starts charging. So we have become so addicted. However, I don't think WhatsApp or Google would be the companies that would start charging, because their business model is totally different. However, other services like Nika, Amazon, and Uber, Swiggy, Zomato, all of these have started uh, giving us free services right today and incurring a losses, and down the line would start charging.
This is also not correct to understand in each cases the customer will be charged. In many of the cases, the suppliers are being charged, and that is fulfilling their need. So WhatsApp has already started business accounts, and then promotional accounts. For promotional accounts, they are already getting money. So Facebook is still free. It is to be penetrated to as many number of people as required, and based on their market size. Now they are charging from the others to do Facebook AdWords, Google AdWords is there. So all those things they are getting money, a lot of money, and they are now profitable also. So Google, Facebook are already profitable by charging from the seller side, not from the customer.
Somebody
So
just
it will be by product differentiation.
Yes.
As LinkedIn, Premium, Prime, Money Control Prime, ET Prime. So
Yes.
they already, started coming up with different ideas. They give you that you are going to become a different class of the customers.
Right.
And that way they have also, started getting collections from the customers.
Yes, LinkedIn, you can see the premium features,
Yes.
where they have different features, and they are getting a lot of money from that. So that is there.
Very
If you are,
speedily in the new versions, you will see Money Control.
yes.
So Money Control, they have also started doing that.
okay.
Right.
Manoj, somebody is asking what fee you people are charging for evaluation of charge for evaluation of startup. So yeah.
Obviously, commercial discussion we can do based on the case to case. We cannot discuss on without looking at the financials and the size of the company. So we have to look into the facts and what purpose you are doing, needing the valuation, based on that we will do the valuation. So we can privately, you can privately discuss with us and we will discuss.
Okay, and for the benefit of everybody, anybody who is a startup and he has some idea and we are convinced with the idea, please come. We will not charge hard cash. We will take up in kind and future money, but idea should be convincing to us. So you can freely contact us. We can provide you mentorship also. We can provide valuation also. We can provide you the legal support also, and the future compliance also. That is also, we have a separate division which we can do this. Okay, if the startup have a software, then how to valuation in such type of startup, Sanchit?
So again, so if a startup has a software that is basically an intangible asset and not a physical asset, in that case, we would value that startup on the basis of the projected future cash flow that the startup would be generating using that software and discounting it to the present value. So all or everything relies upon the future certainty of future projections of that cash flow that the startup would generate using that software, adjusting it to the various volatility, risk factors, and discounting it to the present value. And taking out that present value, approximately, we will consider various other factors. We will use different volatility and risk factors in consideration of that startup. So that is one of the key criteria to value startups through a discounted cash.
Okay, very interesting question has come, Manoj and Sanchit, for you. Somebody's address, Mr. Sanchit, because you were saying, but we see the Paytm is the biggest share of its market, and it's a long time they are into, and now they are listed also. But still they are into huge losses. So there is no look of profit. So whole motive is to acquire market and not profit generation. Same is like Flipkart. VC will book the profit by selling their shares, but how the other investor will get the shares of profit? Manoj, I think you can give answer, then I'll ask Manoj and
so basically, yes, they have the model which is not yet started earning cash profit, but they have size and they are growing. So as the other investors have got their exit by selling their stake to other class of investors or in the IPO, any person who is investing in IPO or taken share from the market, they may wait for some times and see if the market price goes up. They can certainly exit from by selling in the market. So market IPO would give exit opportunity to all the persons, and it is a liquid stock. So obviously the valuation aspect, valuation is not directly dependent on the present value. It is the future value. They have projected that they will be positive in 2023, maybe in 2024. So based on that, there will be certain perception on those perceptions. Market would factor in the valuation, and it may grow or may not grow for some time. So those decisions, what present market price may not be considered to be the fair price for all time to come. It will grow and it may not grow. Sure. So you have to take investment decision based on those things. But you will get the exit opportunity by selling in the market.
Sanchit, your view?
So again, I can't comment on how Paytm, why is it still in losses and even after so long. But as rightly said by Manoj sir, whenever we do valuation, we keep in mind the future projected value. The future projected value discounted to present value. So in any case, all the valuation that are done keeping in mind the projection that the company share with us, doing a due diligence on that if at all need be, and then discounting it to the present value. Paytm and Flipkart now being listed raised lots of funds, and they acquired a lot of market. They acquired a lot of people, started making them use their services, and it is predominantly more on the revenue per user multiple, as the users of Paytm and Flipkart are so much more that down the line they can use that kind of a user database to command any service or even launch something new. That is what Paytm did. So it started off as a platform where you could transfer money, and slowly and steadily they entered every industry and every sector: insurance, railway ticket booking, flight booking, hotel booking, whatnot. The sole reason for such entering into different markets and channels were only and only because they had a massive user database who started using Paytm to transfer the money. And that is what everybody is going to do. Even Flipkart has a massive database which they can use to market or channel other services. How Amazon did it. They have entered flight booking, they've entered hotel booking, they've entered UPI. The sole reason for that is because they now have that kind of a user base using their services. So whenever you get such a massive database using your services, you can sell them anything.
Okay. Okay. Manoj, do you think the loss-making company is allowed to OFS?
OFS. Yes, they have. In all cases there is a OFS as part of the IPO. The existing shareholder taking exit, so that there is no restriction on how to make the IPO. It may be a combination of fresh issue and sale of shares, existing shares. So other conditions are there, like in case of not profit making entities, the QIB portion is higher, and obviously the merchant banker, investment banker have to underwrite the issue. So those conditions are there, but no restriction on OFS.
Okay. Maluji, you have any view on that? The offer for sale should be allowed for loss-making company or not?
This means, as already replied by Manoj, I think the better valuation may not come for offer for sale. Better valuations for in case of startups comes by VCs or private equity. Since they only understand it takes time that public in general understand the vision and the uniqueness of the thing. So I will not from practical aspects, I will not advise that they should go for offer for sale. They should go for private equity. And when then the model becomes matured, then only they should go for the listed one, or maybe they may go for the international markets, not to the Indian markets.
Okay. My question is, why should be allowed that we have given answer. Okay. So friends, now we have tried to give all the answer. If anybody's answer is not they are not clear, or they want something additional point, they can write to us. We will reply to you. So here we want to end this program, but as a ritual, we have a practice to ask 1 minute concluding remark from all the speakers. So I'm coining the question that what you think in the startup era, valuation will play an important role. Maluji.
Sir, this means startup starts with the unique idea. And that unique idea comes, ultimately that unique idea has to come into case in hand. This means case flow has to be there. So that time period is decided. And for that time period, you need the money. So early you dilute the equity, you may not reach to that level.
Okay.
And therefore, right valuation is very, very important. Right financial product is also very important, in addition to team and other things. But I think that this is the foremost important reason, that what sort of a time period we want to take to reach to that idea, that the persons in general or public in general can understand. And with that speed, we have to dilute.
Okay.
Right valuation.
No, it's one question somebody asked.
Yes.
Please give answer, then you give the answer of my question. For valuation of new age industry, how the price are discovered while going into markets is no history of pre-IPO valuation.
The valuation is not discussed in public domain for the purpose of IPO. IPO, there is no specific formula. Obviously, it is based on the perception of the lead managers who are raising the funds, They have the past track record of the company. Company has raised multiple rounds of funding before going for IPO. So and at the time of last round of funding, what was the size of the business, and at the time of IPO, what is the size of the business? That is the major consideration. But besides that, obviously they would check it by doing the discounted cash flow and determine the tentative valuation, and then they will decide considering what is the perception in the market and investor sentiments towards the company, and they, based on that, the price is fixed. So it is not directly linked to any price earning multiple or EV to EBITDA or something like that.
Okay, I hope, Mr. Patel, your question is answered. In case you have any additional point, you can send it to us. So Manoj, the point which I concluding remark.
Yes, so valuation is very, very critical in case of startups, because startups cannot raise money through debt. Most of the startups are not able to or not meant to take loans at their earlier stage till they are startups, because they have the model which is scalable, but they don't have the cash flow to meet the regular payment to the banks, pay interest in, and that interest portion cannot be built in the system. So only option is to dilute equity, to raise fund through equity or convertible instrument. And equity or convertible instrument will come only through valuation. So valuation of the company becomes very, very critical. Now it is up to for the founder to see what is the right time to take the money. They understand the need of the money, but till what time they can drag that need, postpone that need and take the money. It should not be such a postponement that the company collapses. So collapsation should not happen, and hence dilution becomes very, very important. But right time dilution, right fair value dilution is very, very critical, and hence each startup need to determine their inherent value, intrinsic value before going to the market for raising the fund.
Okay, Sanchit.
Yeah.
So as we all know that startup are booming in today in Indian industries, Indian circle, and valuation holds a very key and prominent role in such a space. The most important aspect here that I would want to reiterate is that valuation helps you in an early stage to negotiate the right value with your investor and benchmark yourself that whether that idea can be succeeded or not, depending upon your own circumstances and case-to-case basis. Definitely down the line, regulatory valuation do come into picture, but an internal planning purpose valuation is required at every step. We would have to forecast the financial model. We have to see the fundamental issues in that, see whether the expenses, projections, revenues are in line with the idea that you have created. So that being said, we have to make sure that valuation depicts the fair value, whether it's a pre-revenue startup or an idea-based startup or an already established one. So in that sense, it will be a very pivotal role for any discussions to be taken place thereafter, whether it's to acquire any other company or have another promoter or raise funds.
Okay. So thank you very much. Thank you very much, Manoj, Maluji, and Sanchit. Friends, those who have participated, lots of people are in the industry. My advice to all of you, you should have an idea. First, you should have a conviction. Talk to the people, test that this is the idea. And then you have to do two things. Search some mentor. It is not that finance is always important. The mentoring is also important. Who can guide you, who can help you, and who can make you your way and suggest you the mistakes which you should not do in your journey. And whatever you are doing, the valuation part is always important. Whatever you do at the early stage, you will get more, you have to sacrifice more percentage. So that's why build up something and build up in such a manner that you can do something great by taking the money, and take money in pieces. Don't take money at one go, because if you are not using that money, you are shading your investment, your percentage, which can be higher after some time when you are using the money. So you make your money plan, discuss with the investor that you require this money, and after that you will do the valuation again, and then you will take extra money. So that will fetch you more money, and that is principle not only startup but any business which is there. So with these things, we are closing this session. And as you are aware that every Friday we are organizing our program. So in this same journey, we will continue our program. So our next program on Friday, that is on very interesting topic, SEBI, the PIT regulation, that is the insider trading, judicial decision shaping the law. So there are so many recent cases which have come. We want to discuss that this is one important thing where everybody is covered. Whether you are a listed company, you are a promoter, you are an employee, you are a consultant, you are somebody who has heard something while discussing by others by mistake. That is also, like, take example, I send an email to you, and that email is about the company which is coming out with some bonus issue or something, and you got it, and you have no connection, by mistake you have received, but you have become insider, then that you have got the information, and you have to be careful. So in this journey of this PIT, everybody is connected, everybody is related. So we want to discuss the PIT, what do's and don'ts you have to do. Second, we want to discuss recent case laws which has given the new dimension and new definition of PIT regulation. Thank you very much. Thank you all. In case you have any question is unanswered or any question you have not able to ask, please send it to us. We'll reply you. Thank you very much. Thank you, Malini. Thank you, Manoj.
Thank you, Ji.
Thank you.
Thank you, everyone.